In this video, I'm going to present a straightforward indicator that can help you make highly accurate pullback entries. We'll cover what this indicator is and how you can use it to trade effectively. If you find this valuable, don't forget to leave a like. Let's dive in. The indicator we're discussing is called the FVG Positioning Average, developed by Luxalgo. To add it to your chart, go to Trading View and load any trading asset you prefer on any time frame. For this demonstration, I'll be using the 30-minute time frame for GBPJPY. After loading your chart, click on Indicator, search for FVG Positioning Average by Luxalgo and select it. The FVG Positioning Average is a technical analysis tool that helps traders pinpoint potential price levels of interest by averaging the starting points of recent fair value gaps FVGs. A fair value gap is a price gap caused by significant buying or selling activity. For example, here we see a sudden price jump, and just before this major move, this particular candle is noticeably larger than the others, indicating a bullish fair value gap. Conversely, a bearish fair value gap is shown here by this significant price drop, where a larger candle marks the onset of the move. An initiation point, in the case of a bullish fair value gap, refers to the origin of a gap. You'd label a fair value gap from the high of the previous candle to the low of the next candle. For instance, here is our fair value gap, and the initiation point is located at the bottom of the bullish fair value gap. The reverse applies to a bearish fair value gap, with the initiation point at the origin of the gap. This indicator averages these initiation points to calculate and display the trend ribbon you see on the chart. When checking the settings of the indicator, you'll notice that the initiation points for bullish fair value gaps create the bull average, and for bearish fair value gaps, they form the bear average. We'll use this information to identify market trends and pullbacks for entry points. If the trend ribbon appears teal and prices consistently trade above it, that signals a bullish market. On the other hand, a red trend ribbon with prices trading below it indicates a bearish market. Now, regarding the indicator settings, we can adjust the FVG lookback length, which determines how many FVGs are considered in calculating the trend averages. There's also a lookback type setting, which can either count bars using any FVGs within a specified number of candles, or FVG count using only the specific number of FVGs. Additionally, the ATR multiplier allows you to filter weaker FVGs. A larger multiplier, like 2, filters out many FVGs, so smaller values less than 1 are preferable. For this video, I'll stick with the default value of 0.25. You also have the option to show or hide FVGs in gradient areas, though I'll leave these settings as they are since they work well with my strategy. To trade effectively with this indicator, you need to add one more indicator for identifying long-term trends, the exponential moving average EMA. Add it to your chart, set the length to 200, and adjust the color to something more visible. I'm choosing yellow. Then click OK. Next, let's discuss using these two indicators together for your trades. To take a long position, you need to meet the following criteria: confirm a long-term bullish trend by ensuring the price is trading above the 200 period EMA. Using the Luxalgo FVG Positioning Average, ensure the short-term trend is bullish with the trend ribbon color teal and price trading above it. Identify a pullback by observing a red bearish trend cloud formed by a bearish FVG pattern. Once a candle breaks and closes above this red cloud, signaling the end of the pullback, enter a long position. Place your stop loss just below the most recent swing low and target a risk-reward ratio of 1.5 to 1. But if you want to make way more than that, watch the entire tutorial, because I've got a surprise for you somewhere just before the end of this session. For a short position, follow the reverse steps. First, confirm a long-term bearish trend by ensuring the price is below the 200 period EMA. Next, confirm a short-term bearish trend with a red trend cloud, and the price should be trading under it. Lastly, look for a pullback signaled by a small green cloud. When a candle breaks and closes below this cloud, take a short position, placing the stop loss above the most recent swing high and aiming for a 1.5 to 1 risk-reward ratio. This strategy also works well when combined with a multifunctional price action and smart money concepts indicator, which identifies break of structures BOS for additional confirmation. Using this, wait for a candle to break above the most recent swing high or below the swing low for shorts to confirm a BOS alongside your other conditions. The new tool we introduced is Market Dynamics Pro by Chart Prime, a powerful multifunctional indicator offering features like order blocks, liquidity zones, premium discount levels, and more. You can try it using the link in the description. Before we wrap up, if you want to dive deeper into trading strategies, check out the videos on the screen now. The top one is all about Fibonacci levels with my customizations, and the bottom left will show you how to automate this strategy into a bot with alerts. And don't forget, the bottom right is another viral trading strategy that's blowing up right now. Thanks for watching, and as always, may the charts be in your favor. See you in the next video.